So you know what the wave is, you know how to take the reading of an uptrend and a downtrend. What about, there's two other trends, there's four trends in total. When Charles Dow was teaching market trends, he had three trends he talked about: accumulation, markup, and distribution. Because he talked mainly about the stock market, and that meant he had a bullish bias because stocks, for the most part, are bought with expectations that they'll go higher. So keeping that in mind, and in all due respect to Mr. Dow, obviously in Forex we can look at prices moving lower as well. So we have accumulation, markup, distribution, markdown. And we talked about markup and markdown. What about this accumulation and distribution? Those are sideways market cycles. And the way we identify those is still with the wave, still within the market memory. But if markets are moving sideways in a quiet range, okay, within a definable sideways range, some people will call it a channel or a rectangle. Okay, it doesn't not necessarily have to be, but sideways quiet range, that is accumulation. Think about what it means to accumulate, by the way. Don't let these just be words, you know. We know what an uptrend is. It's the sentiment of the bulls. Prices are moving up higher. Not only are they moving up higher, but we're ending up with lower highs. That's support. That's what an uptrend is. Think about what a downtrend is. It's pressure. It's selling pressure, right? The bears are in control. We end up with lower highs. That's the resistance, right? To accumulate means to what? To gather, to collect, right? That kind of gives us an idea of things being bunched up in a small area, right? Accumulate. Accumulation comes from the word accumulate. Things are gathering. They're bunched up. They're moving quietly sideways. What's the psychology of that? It's like a coiled spring, okay? It's like a coiled spring where prices are moving in a sideways manner without any kind of trending properties. They're not moving up higher, they're not moving up lower, they're just gathering, right? And this also reflects a lack of opinion in the market. You know, think of what a trend is. It's imbalance, right? If markets are moving up higher, think about economics 101. Think about supply and demand. Things move up higher when there's not enough supply and a lot of demand. Things move lower when there's no demand and too much supply. Okay, what happens when prices are moving sideways? There's a balance, right? A balance between supply and demand. So that's what accumulation is, a sideways market. Think about the psychology of what gets us in a certain market direction. Don't just let this be, you know, just kind of a mechanical thing. Think about what the human behavior, what the human opinion is, because all we're trading is opinion. We're not really trading the euro-US dollar, we're trading the opinion of the euro-US dollar. Okay, human opinion. So if accumulation is this gathering, this collection, sideways, its cousin would be distribution. Distribution is also sideways. The distribution comes from the word distribute. And in the way that Charles Dow used to teach it, and I'm paraphrasing here, but essentially distribution would most commonly occur at the top of an uptrend. So prices would rally, and what would happen is people who had not been in on the trend, had not benefited from the trend, they would come in and they would want to buy. They notice the prices went up, they're upset they missed it, and they're going to buy it now. Usually kind of late to the party, right? We see that in Forex too. We see it in every market. These market cycles are certainly not limited to being effective in any one market. You'll see it in stocks, you'll see it in futures, you'll certainly see it in Forex. So this distribution is basically where prices have moved. They don't necessarily have to happen after an uptrend. They can happen after a downtrend too, but the way Charles Dow taught it is after an uptrend, another wave of buyers would say, hey, we missed this move, we want in. But then think about the participants who are already in the market as prices rallied. They're getting out. So what happens? What does it mean to distribute? Think about passing out things, distributing something. Think about what that means. So if I'm going to distribute my shares, I'm essentially doing what after a rally? I'm selling them, right? And I'm selling them to buyers. So if I'm going to have basically this distribution type mentality, one wave of participants is getting in the market, another wave of participants is getting out of it. So you end up with two pretty volatile opinions, right? You have some people that are saying, hey, this move is done, I want out. because I've been long this entire time. And you have another group saying, oh my gosh, look at this move I missed, I want to get in. Pretty wide opinion, right? Two very different objectives. And that's why distribution ends up being much more of a volatile sideways market. So accumulation is sideways, but the psychology behind it is very different, driving it. Distribution is sideways too, but again, the psychology driving it is very different. So accumulation is identified by basically a flat 3 o'clock wave angle. A flat 3 o'clock wave angle. Distribution is easier to identify by what it's not. Hear me out here. If I said that a markup is 12 to 2, markdown is 4 to 6, and accumulation is flat and 3 o'clock, the easiest way to identify distribution is by what it's not. When prices are not steep enough to be an uptrend, they're not steep enough to be a downtrend, and they're not flat enough to be accumulation, the only thing you have left is distribution. So it's a process of elimination. That's the easiest way to identify that more volatile sideways market. By the way, in that volatile sideways market, prices tend to exhaust at highs and lows. There's very little follow-through because there's no solid opinion, there's no strong sentiment in the market. Prices move back and forth with a lot of volatility, but they tend to exhaust at support and resistance. That's really a key characteristic of distribution. So if I have these 4 market cycles, in my opinion, what I found is I basically need 4 trading approaches to the market. You know, some of us might like following a trend, and we might have a trend following approach, and that's great. Okay? But I have to have a way to identify the trend first. Some of us might like to trade breakouts and breakdowns from that accumulation market cycle. When the market's coiling, when there's no opinion, we wait for that momentum shift. That's great. But we have to have a way of identifying when we are in that sideways flat market. So there are momentum strategies, and there are distribution strategies and trending strategies. But when you apply them, in my opinion, should be dictated not by when you simply want to, but when the market is telling you it's trading in the market cycle that is most appropriate for that entry. Does everyone follow what I mean? So your trading entries are dictated not by the basket of entries that you have or your want to apply a certain one. It should be the market telling you, hey, I'm trending. What are your trending strategies? Hey, I'm moving sideways. What is your breakdown strategy? Or what's your fading or exhaustion strategy? It should be dictated by the market's behavior. Too often we learn a new strategy and just start applying it to the market. I like to go back to a simple tools analogy. You know, the greatest hammer in the world, the most beautiful, well-balanced, best metal, best wood handle, whatever it is, the greatest hammer in the world is useless if you have a bag of screws. It's just that simple. So it's not a matter of a strategy being good or bad. It's about the application of it. Now, certainly if you have a bad strategy, you know, I'm being slightly facetious, but in my opinion, it's more what I found is in this internet age, I think that bad tools, bad strategies, bad ideas, and what I've seen get weeded out very quickly because we share information on the spot. I don't care if it's Twitter, Facebook, blogs, forums, chat rooms. Things get found out to be good or bad very quickly, you know, at the rate information moves nowadays. So to me, it's really a matter of these strategies that you've found and collected and you've said, okay, this is how I want to trade. When do you decide to apply them? Have you thought about that before? And this is kind of a rhetorical question, but I do want you to think about that. This was something I asked myself years and years and years ago. How do I decide that I want to apply a certain strategy? Okay, if we looked at the market cycles here, and we let market cycles determine that if there's a trend, I look for trend following or trend reversal strategies, or if there's no trend, a sideways market, I wait for those either breakout, breakdown, or exhaustion strategies. I let each market cycle dictate which. So markup and markdowns, I'm looking for trend following or trend reversal. In accumulation, that sideways flat market cycle that I identify with a 3 o'clock wave, I don't know that I have. Okay, that's a pretty good example right there. Okay, not perfect, but pretty good. That might be more distribution. But when I get a flat sideways wave within my market memory, okay, that's when I'll look for breakout and breakdowns. By the way, for those of you that like chart patterns are perfect ways to kind of wrap your